That sounds like good news, right? Incomes are up. Now, of course, everyone who listened to our year-end podcast, one of the most downloaded podcasts of the year, is sitting there going, yeah, we know that, but expenses are also up, and that's certainly true. And
we'll talk about that later.
We're going to get to that. So the median income of our average client is up 5.8%. Does that mean that each of our clients is earning 5.8% more now than they were earning last year?
It certainly doesn't. In fact, I'm not aware of any industry where the unions or organized groups were getting 5.8% wage increases.
Yeah, it's just not the thing. Yeah, so the inflation rate is running at that's a whole nother discussion. But so the average wage for the average person was up, a couple of percent last year.
Cost
of living. So what is actually happening then? Why are we seeing this in our numbers?
So this is one of those interesting side effects of using averages and medians and means. It's the average person may not be a real person at all. So what we've got is more people at the higher level of income shifting our entire graph to the right. So it's not that everybody got a 5.8% raise. It's we've got more people earning more money now filing insolvency.
Yeah, and we're going to put a graph up on the screen for those of you who are watching on YouTube who can actually see this shift happening. So the way we kind of visualize this, and you and I have been talking about how to actually present this. Right. So there's two people they both work at the same office, the same factory, or whatever. One guy makes $39,000 a year. The other guy makes $43,500 a year. Well, 2 years ago, it was the guy making $39,000 who had to file an insolvency because he couldn't keep up. Today, it's the guy making $43,500 who has to file.
That's a perfect explanation. So what we're saying is the people that were most at risk 2 years ago, that the demographic has shifted. It's now people earning more money that are at risk because the guys that were at that lower level have already gone. Well, and the statistic that becomes, I guess, most alarming for us is there's actually less money for debt repayment now than there was last year. It stayed pretty consistent around $260, $270 a month. And you can't service the debt levels that the people that we see have on that kind of money. It's just not possible.
Consumer debt, and this is, again, our clients.
Yep.
Their consumer debt has gone up in 1 year from $57,840 to $58,923, so almost 2%. And to be very specific, and again, this is all in our information on the website, we're not talking just about unsecured debt. We're talking about consumer debt.
Yeah, so you got your car loans in there, right?
Yeah, exactly. Unsecured debt plus non-mortgage secured debt. So the unsecured debt actually maybe went down a tiny little bit, but this non-mortgage debt like car loans, and again, we're gonna get to that, has gone up. So if your expenses are going up, your income is not going up as fast as expenses. You've got less money to pay your debt.
You have to bridge the gap somehow. And so people turn to credit. And historically, that meant they turned to things like credit cards and personal loans. Those things have all been exhausted, and now we're seeing people are turning to the more expensive forms of credit.
Beautiful.
And that's got to be our next trend.
That's trend
right?
number 3, the deteriorating credit profile. And you're exactly right. So it used to be when you and I started in this business, many years ago.
Hey, speak up. I'm having a senior moment.
Many years ago.
We're going to get email about that.
That's right. We are. The biggest debt everybody had was credit cards.
Right.
People came in because of their credit cards.
And it was thousands of dollars. I mean, I think my recollection from 2011 was like $26,000 in
Well,
credit
it was in 2011, 43% of debt was from credit cards. So it was the biggest single component of it. Today, it's only 30% of unsecured debt. So again, you'd think, hey, that's good, less credit card debt. Well, no, it's exactly what you just said. It's not credit card debt anymore that's the big problem. It's all of those other things.
Right.
So the average person has less than again, these are our clients, has less than $15,000 worth of credit card debt. That's a 6.4% drop from last year. That's huge.
Right.
But what are they replacing it with?
Well, so they're replacing it with the really bad, really expensive forms of credit. So for lack of better terms, let's call them payday loans, high interest installment loans. It's all the same companies.
So explain what a shortfall on a vehicle loan is.
All right. So when you borrow for a car, you sign a contract saying, I'm going to pay you back this much money. As soon as you drive that car off the lot, it's worth 20% less than whatever you paid for it, whether it was new or used. So suddenly you've got a loan for, let's use a number, $30,000, and the car is worth $25,000 the second you turn it over. That problem gets progressively worse for the first 3 or 4 years of a car loan. You're always underwater. You owe more than the vehicle is worth. And so a shortfall on a car loan is whatever reason the car's had to go back. Either they repossessed it, you voluntarily returned it. It doesn't matter. The car is no longer in your possession. but you were underwater. You still owe them money for this car you don't have anymore. And it's getting to be a big problem. Well, our numbers show it, right?
Yeah, it's always been $10,000.
Right.
That's
just what it is.
Somebody walks into my office, I don't even have to look at the numbers, it's $10,000. Well, in fact, we actually did look at the numbers.
Yep.
And the answer is yes, it's $10,000. So 66% of debtors owned a car at the time of filing. Okay,
Right.
that kind of makes sense. And I want our listeners to understand, we have offices from Windsor through the GTA out to Ottawa.
So we represent Ontario in a
all
pretty
of
good
Ontario.
way.
Now, in my downtown Toronto office, very few people have a car.
Right.
I mean, I would be shocked if it's 1 in 10. Whereas in your Guelph office or your Oshawa office,
Just about all of them have
pretty
cars.
much everybody, because
you have to.
there's not much of a subway system in either one of those two cities.
Yep.
So we're giving you averages here. The average value of that vehicle was about $11,500. 39% of those people owned the vehicle outright. Not surprisingly, it was about a $3,700 vehicle, because
Right.
it's a car I just bought. 61% of vehicles are financed. Well, I guess you could have figured that out at 39%.
Did the math, yep.
Finance. There you go. It was 43% if you go back to 2011. So a lot more of the vehicles we're seeing are financed. And of course, the average vehicle financed is around $16,500. Again, kind of makes sense, right?
Right.
The average secured debt, $17,500.
Yep.
Up again. And as a result, 28% of the vehicles that are financed have negative equity. The car debt is around $24,000, so a higher number. And the average shortfall, $10,380, which is kind of what we typically see.
And so the goal of this wasn't to lose people in the numbers. It's for everybody to understand, when you finance a car, as soon as you drive it off the lot, it's worth a lot less than what you paid for it. That's just the way it works. And one of the worst things I saw in the whole consumer credit industry in the last 10 years is they've extended car loans now to 5, 6, 7 years. And so it used to be you had to finance a car in 4 years, maybe 5, and you were underwater for the first 3. Well, if you finance a car for 7, you're underwater for the first 5.
And why are they 7 and not 5?
Because nobody can afford the payments on
Math.
a 5-year car loan, right?
Yeah.
And think about it. The amount of extra interest they're making for those extra 2 years is phenomenal. I mean, it's like a mortgage. You pay for your house twice. We're going to get to the point where you're paying for your car